You ever look at a stock's financial page and your eyes just glaze over? Yeah, you're not alone. In the next 5 minutes, we're going to show you how to cut through all that noise with a super simple framework, inspired by the master himself, Warren Buffett. Let's do this.
So you find a company you're actually interested in. You get excited, you pull up its financials, and then, well, you run into a little problem that hits every single investor. Wham! You get hit with this absolute wall of numbers and acronyms. I mean, it feels like you need a PhD in finance just to figure out where to even start. It's confusing, it's totally overwhelming, and frankly, it's where most people just give up.
So the big question is, what do you do? How do you turn this mess of data into something that actually makes sense? How do you find the real story that's hiding in all that noise? Well, that's exactly what we're about to do.
And this is how we're going to do it. We're going to use a simple but really powerful checklist to turn that wall of data into a clear story. And we're going to use a real company, Synchrony Financial, ticker SYF, as our test case. It all comes down to just 3 questions.
All right, here's the entire game plan. It's a 3-step investigation. First, is this business actually good at making money? Is it profitable? Second, is it getting bigger over time? Is it growing? And third, the big one, can we buy it for a good price? That's it. Let's jump into step 1.
First things first, we have to know if this company is a solid money-making machine. So question 1, is it a profitable business?
And this is exactly why we start here. You know, Buffett's famous rule isn't about avoiding risk entirely. It's about building a foundation on solid companies that just consistently make money. That's your best defense against losing your shirt.
So, how do we check for that? We're going to use one key number, return on equity, or ROE. Just think of it like this. For every dollar the shareholders have invested in the company, how much profit does the company spit out? A good rule of thumb? Anything consistently over 15% is pretty strong.
So, what about Synchrony Financial? Well, its return on equity is a very, very healthy 20.69%. That's not just beating our 15% benchmark, it's crushing it. This tells us that management is doing a fantastic job. So, for step 1, that is a big, fat green check mark.
Okay, so we know the company is profitable. That's great. But we don't want a business that's just standing still. So, on to question number 2 in our investigation, is this business growing? Now, this table just shows us how fast the company's been growing over the last few years. And, it's a bit of a mixed bag. Revenue looks pretty solid, but look at the difference between net income and EPS, or earnings per share. That strong EPS growth is key. It tells us that even when income bounces around, the company is still making each share more valuable for investors, probably through things like stock buybacks. So, the bottom line for us as shareholders looks really good.
All right, so we've got a profitable company, and it's showing some decent growth. But all of that leads us to the final, and honestly, the most critical part of our analysis, the billion-dollar question.
Because look, you could find the most amazing business on planet Earth, but if you pay too much for it, it's still a terrible investment. So the question is, what is a fair price, and are we getting a deal today?
Okay, first, let's look at the sticker price. When we ran this analysis, the market was selling 1 share of Synchrony for $76.62. That's our cost. That's what we have to pay. But as they say, price is what you pay, value is what you get. So, what's the business actually worth? We can figure out a pretty good estimate by looking at the cash it's likely to produce in the future and calculating what all that future cash is worth in today's dollars.
And this is where the story gets wild. Based on that analysis, the calculated fair value price for this company is $718.21. No, that is not a typo. The difference between what it's selling for and what it might actually be worth is just enormous. This huge gap, this chasm between the price you pay and the value you get, this is the holy grail for value investors. It's the one thing they're always searching for, and it has a name. It's called a margin of safety. Think of it like a buffer. It's your room for error. It's your protection against bad luck or bad news, or even just you being flat out wrong in your analysis. The bigger that margin is, the more things can go wrong and you can still come out ahead. So for Synchrony, based on these numbers, that margin of safety is a jaw-dropping 89.33%. To put it another way, this suggests you're getting the chance to buy $1's worth of value for just a little over 10 cents.
Okay, wow, let's just step back and put this all together. After our 3-step investigation, what's the big story here? What's your key investor takeaway?
So here's the final report card. Profitability, A+.
It's a money-making machine. Growth? It's decent, and it's strong where it matters most, for shareholders. And the price? Well, it looks like it's sitting in the bargain bin of all bargain bins. The story these numbers tell is of a very profitable company that might be on sale for an incredible price.
And that leaves us with the final critical question that you have to ask yourself as an investor. When you find a margin of safety this massive, is it an automatic screaming buy signal, or is it a warning sign? A sign that maybe the market knows something you don't and that you need to dig even deeper. That right there is the art behind the science.